Okay, all right. Morning, everyone. Welcome back to our morning kappa at 8. I'm Joseph here. So, looking at the first news of today, right? This morning, right? We just saw that Donald Trump had defeated the proposal by the Iran rep, right? He mentioned that the proposal is totally unacceptable. We shall see how this message will affect the sentiment on the oil market, right? But as of now, the Hormuz Straits remains blocked, right? And seemingly no traffic, no ships are out from the Hormuz Straits at this juncture. And next message that we'll be looking at was last Friday. The US have released their non-farm payroll in the April. They managed to add another 115,000 jobs. That was much better than a forecast of 62,000. Despite that, month on month, the April job was slightly lower, right? But nevertheless, the job in the April still beat the forecast, which is 62,000. And at this juncture, right, looking at the Hong Kong index, it's continued to move sideways. This coming Thursday and Friday, right, Xi Jinping and Trump is going to have the summit at Beijing, right? Markets looking at what would be they discuss regards the tariff between the US and China, and also any issues that are pertaining to the Taiwan and also the Iran war, right? Looking at the Hang Seng, right? Setup remains bearish until it break past the 600 point level. Now, overall, on a weekly basis, we can see that a few big cap stock have managed to stage a rebound, led by the 981 SMIC, right? And then on last Thursday and Friday, we also saw the 9988 Alibaba have jumped above resistance, right? And looking at the Alibaba, right, you can see that the share have climbed above 140. Next level of resistance will be at 155 and followed by 170. Now downside support is at 128, and next 2 days, over the next I think on Wednesday, right, Alibaba is going to announce their half yearly reports. Meanwhile, another counter that under our trading idea last week was a CK Hutchinson stock code 001, the Hong Kong, right? It has managed to climb high on the back of high trading volume. But it has managed to break past 70 Hong Kong dollar, and right now heading towards 75 and towards 80, right? CK Hutchinson's, right? Look at the price to book, right? Right now actually at a very attractive level, right? And CK Hutchinson also one of the index component stocks. It shows that the market have become more positive sentiment on them, and hopefully it can reach 80 resistant too, right? Meanwhile, we have two more counters to share with you this morning. Firstly, the CMOC 3993. They also break past the Hong Kong dollar 20 Hong Kong dollar. Next hour will be 2150 and followed by 23. Down support is 1850. Now look at the Hong Kong market, right? Usually the sentiment is actually quite strong for the commodity related stocks. At this juncture, right, the funds are actually looking at the FMOC. Now, secondly, Lenovo Group 992, it has been breaching the resistance. About 2 weeks ago, we mentioned about Lenovo, right? R2 was at 1250. Right now, they managed to reach their R2 1250 and going towards the next resistance at 1350 and followed by 1450. So over the past 2 months, the trend on Lenovo was strong, and the trend not only a higher high, right? It also backed by a rising volume, right? So showing that their momentum is very strong on the Lenovo group. So we have two breakout stocks this morning on the Hong Kong market, CMOC 3993 and followed by Lenovo 992. Now, meanwhile, the over the US market, right? Over the just 1 week period, you can see that the markets are still chasing the big cap stocks, especially the memory counters. Micron have managed to grew 45% week over week. SNTK returned a much stellar performance, 47% just over the week. And then on Intel, right, I've jumped 34% over the week as well. Nvidia has been quite sideways, although it's a sideways, but still move higher 7% over the week, right? And at the US market, you have two choice now: either continue to chase on the big cap stocks, right? The Micron, SNDK, or the chip stocks, the AMD, right, Intel or Nvidia. Now, another category of stocks that I'll be looking at is the those are machines provider, such as the Lam Research that we have mentioned about last week. So today we'll be looking at the Apply Map, which they also break past their resistance of 420. Next hour is 450 and followed by the 480. Now, another category of stocks that last week I've mentioned is the cybersecurity related counters. Now, Cloudflare have delivered normal results, but their guidance mentioned that they are going to have a downsize on their manpower. That's where I see a very strong selling pressure on Cloudflare. It breached our stop loss point at 200, so no choice, we are being stopped out on the Cloudflare, but still remain positive on the overall sector. And last week, data stock, another cybersecurity stocks have delivered above expectation results, break above the 180, right now challenging the 200 US dollar resistance. So next hour will be at 220 and followed by 240. Now another cybersecurity stocks that yet to announce results would be the CrowdStrike. That you can actually look at CrowdStrike for this week. Apart from the cybersecurity, right? The demand for server remain very strong. So we'll be looking at the Cisco system, just break past the 95 US dollar. So next hour will be 100 and followed by 105. Downside support is at 90, right? Let's look at the Malaysia market. So last week, we have a very strong performance on the tech and the property sectors. Tech have went up by 6.4%, and the property have gained about 3.7% week over week. And then on utility also staged a very strong rebound of 3.3%. The energy, plantations, and industrial three sectors have experienced selling pressure over the week, right? FKLI will still keep a bullish bias despite that Friday we saw a mild corrections. Now, overall, technical setup remain bullish with the stop loss point unchanged at 1690. Now, FCPO have did 3 consecutive session of corrections. Right now, testing the immediate support at 4005. Now, we see that this 4005 is a very crucial support. Now, if breach the 4005, the technical setup more favors on the downside. Now, this juncture will still keep a bullish bias with our stop loss point at 4005, right? Now, as for the Malaysian market, I think that over the week, sentiment remains bullish. Last week, we saw the YTL and YTL Power. Now, YTL Power went up by 8% and YTL Power went up by 6.6%. Now, over the week, the bank stock remains very resilient together with Tenaga. So if the index were to move higher, right, I think the banks or the utilities will definitely play a very strong catch up. And another counters that I'll be eyeing at over the market is Syarikat Takafu. Right now, testing the 3.45 cents resistance. Breakout happened. The next level will be 360 and followed by 3.75 cents. Now, this juncture, research remains a neutral call on Takafu. But look at the report, Takafu this year, FY26, is giving in the region of about 5% dividend. As for this morning trading stocks report in Malaysia, we have the Kosan and as well as the CloudPoint. You may look at the reports afterwards. So I stop here and pass on to Sian on the Rasa Mingguan weekly report.
Thanks, Joseph. So good morning, everyone. Please let me to share my screen now. Okay, I hope you can see my slide now. So over last week, or at least until Friday, Strait of Hormuz reopening of Strait of Hormuz has dominated the market sentiments. But however, US macroeconomic indicators are weakening. So with our RHB US stress heat map underlines higher instances of lackluster or disappointing data in the latest month due to poorer labor, housing, and manufacturing activity. So, however, the risk sentiment index still sees some improvement, although US stocks still move to record highs as AI memes move higher on strong earnings data as well. So on last week, we have also published the Malaysia thematic report where we refresh our composite leading indicator. So which also still suggesting there's no evidence of a significant slowdown in Malaysia GDP growth in the second quarter. So despite of heightened geopolitical premiums. So top-down approach suggests a 5.3% GDP growth in second quarter, which is similar to first quarter. So we still keep the Malaysia annual GDP growth at 4.7% in this year. So although a strong second quarter GDP growth clip, if materialized, we will suggest an upside bias toward 5% growth in this year. So versus our baseline GDP forecast of 4.7%. So just to show you that RHBB sentiment index is still on a risk on territory, where the readings above 0 means that currently market is on the risk on mode. However, the recent slowdown may suggest that the rally fatigue may be on the cut, especially over the weekend. We also see that the peace talks between US and Iran seem to have stalled when US actually reject the Iran peace deals as well, as mentioned by Joseph just now. So, which also renew the concerns over when the Straits of Hormuz will be reopened. So, and then moving forward, so we also see that there's a hitting up in the global inflation on global wise and also on ASEAN, with Philippines seeing an inflation at 7.2% in April, which is the highest since March 2003. And Thailand also exceed deflation. Singapore is likely to see an inflation print of more than 4% in April as well. So moving on into Malaysia. So we have also seen that Malaysia has also released the MPC OPR decision in last Thursday as well, where as expected, OPR actually stay at 2.75% in May. And we do see that the OPR is expected to stay intact at 2.75% for the rest of the year. So with the monetary policy remaining data dependent, especially guided by the inflation momentum and also the growth prospects as well. However, we're seeing that escalating geopolitical tension may push up the energy prices, which is already evident in the recent release of Malaysia's CPI and also PPI data. Should the inflation exceed the official forecasted range of 1.5 to 2.5% and remain persistent, the possibility of a 25 basis point rate hike by this year cannot be ruled out entirely. So in the MPC statement itself, MPC still consider the current OPR appropriate to support the economy while maintaining price stability, and also continue to actually express the concerns over uncertainties arising from the ongoing conflict in the Middle East, with the impact on the global and Malaysian economies depending how the situation actually evolves. So on Friday, for Malaysia, we are seeing the release of the IPI data for the month of March as well, where it sustained at 3.1%, which is unchanged from the previous month, but came in below our in-house projection of 3.7% and slightly below the Bloomberg consensus estimate of 3.5%. So we maintain a constructive outlook on the manufacturing sector while remaining attentive to external development with steady domestic demand as what we're still seeing now, and still resilience in the E&E segment, we are supporting our in-house IPI growth forecast of 4.1% for 2026. However, we are seeing that manufacturing sector are still remain sensitive to external uncertainties and input cost pressure, particularly from higher oil prices, which could raise fuel, transportation, and other energy-intensive production costs as well. So as what we see in the March itself, producer level cost pressures are gradually building up across both goods and services sector, with the PPI rose by 1.1% and has ended a 12-month decline amid a higher utility cost, while manufacturing and agricultural also shows signs of rising cost pressure as well from the producer end. So meanwhile, the services PPI accelerated to 2.1% in the first quarter, compared to 1% in the fourth quarter 2025 due to higher costs in accommodation, food and beverage, and also transportation services. That's all from me. I'll pass the line to the next presenter. Thank you.
Thanks, Sian. Yeah, so moving on to property sector, we have a sector note today, mainly on the second quarter outlook as well as earnings preview for the for the January-March, which will be released this month. So key catalysts for our overweight sector rating is stronger news flow ahead of stronger demand and also property demand and also land transactions in Iskandar, Malaysia, driven by the upcoming completion of the RTS link. Second, foreigners, upgraders and downsizers to fill the demand for large luxury homes at premium areas. Third, property is a good hedge against rising inflationary pressure. And fourth, we expect interest rate environment to stay conducive, supported by strong US dollar. The recent share price recovery indicates that investors have looked beyond or looked past the impact of the US-Iran conflict. Share prices corrected in March, April, and the expectation of margin compression. However, unlike other sectors, we think developers typically have better flexibility to reconfigure their product designs, build-ups, materials, and also pricing in order to mitigate the impact on margins. For the upcoming results, we expect developers' earnings for the first quarter calendar year to be largely intact or largely in line, or just slightly below expectation, as first quarter is typically weaker compared to second half. From our recent discussion with a few developers, many still see demand being rather resilient during the quarter, although the US-Iran geopolitical conflict only kick off in end February. Generally, developers do not see major impact on their margins for the January-March quarter, but they caution that if the war is prolonged, profit margins over the next few quarters may be somewhat affected. A small number of them guided that there could be some provisions on of higher construction costs for past and also current projects. So any of such impact on margins could be seen in the upcoming results. We do not expect developers to lower their property sales target upon the release of the May results. Some may just wait and see before revising, while the majority of them are still going ahead with their launches as planned. So in terms of margin or increase in construction costs, this is not really new. Developers have gone through many rounds of cost increase in the past, including the implementation of GST, SST, labor shortage, and post-COVID-19 pandemic, cement price hikes, and also now, diesel price hike. So past experience have shown that developers are able to cope with these operational challenges via, just the reconfiguration that we've just mentioned. So in regards to the REIT listing, developers are still going ahead with their asset monetization exercise. Value unlocking efforts, as we mentioned in the previous quarter, remain an important catalyst for the sector. There are three major developers that have announced their REIT plan, and this includes Signprop and also Setia. So all three of them collectively are listing property assets worth 13 billion as REIT over the next 2 years. As for Iskandar, Malaysia, demand is still rather strong. The ringgit has strengthened, but rising inflationary pressure in the region remains a push factor to attract travelers from Singapore to spend or stay in Iskandar, Malaysia, at least over the medium term. In addition, major landowners such as Sunrise, KSL, and Crescendo, they are good RNAV play. Land prices are expected to stay at elevated level, as recent land sales by Ecoworld and also Crescendo to DC players were still transacted at record highs within their vicinities. There's no sign of softening in demand. So high-end properties located at premium addresses are expected to do well. Foreigners are feeling the demand for these high-end residences in areas such as Mont Kiara, Damansara Heights, KLCC, and select spots at Istana Malaysia. The take-up rate for the Mint, for example, by UEM Sunrise in Mont Kiara has reached 94%, and Pavilion Square by Pavilion Group in KLCC area is also 80-90% sold. Larger units or dual key units were taken up first, and the leftover is mainly the smaller size units. Down south, Eco World is also launching its Schedule 2 in Eco Botanic Iskandar, Malaysia, which features luxury semi-D and also bungalows priced at 2.5 million and 6 million on average, and this being 2 to 3 times overbooked. So depending on the locations, we understand that foreign buyers make up roughly 20% for some of these projects, while the Iskandar Malaysia region saw foreign buyers coming mainly from Singapore. Projects in KL attracted more buyers from China and Taiwan, as some of them are coming under the MM2H program, while some others may reside in KL for the purpose of business and also education of their children. A few developers such as Park City and also Pavilion, they are bullish with the pricing of for their respective upcoming launches. The maiden phase of Park City Damansara Xenia, which comprises 3-story landed park homes, built up 3150 to almost 4,000 square feet, and also mid to high-rise condo villas built up 1,007 to 4,002. So these park homes will be priced at 2.4 to 4.3 million, while the starting price for condo villas is 1.3 million. So from our recent site visit, we gathered that both landed homes and condo villas have already reached more than 60% take-up, and most of the corner lot landed homes have been taken up first. Meanwhile, Pavilion Square project in KL is more than 80% sold, and the remaining units are mainly the smaller size units. In the pipeline, the company will launch 2 blocks of high-rise resi at Pavilion Damansara. According to some media reports, one of the blocks, Imperial, will feature big build-up areas ranging 3,004 to 4,000 square feet. And there's market demand for big floor plate, which is in line with the feedback we received from other developers. ASP for this project is about 2,000 per square foot. So in our view, such concepts and pricing are a strong reflection of developers' confidence, specifically in the high-end market. While not all areas are suitable for such premium products, developers with exposure to these premium addresses will likely do well in their upcoming launches. Key players are E&O at Andaman Island, Penang, Eco World, Eco Botanic in Iskandar, Malaysia, Sunway City, Iskandar, Malaysia, Masing is redeveloping the Chorus Hotel in KLCC, UEM Sunrise, they are launching the Mint 2 in Mont Kiara, LBS Kwasa Damansara, some premium homes at Kwasa Damansara next year. Real estate remains a good hedge against rising inflationary pressure driven by energy price hike as a result of the geopolitical tension. The increase in building material, labor, land prices should naturally push up the cost to build new properties, i.e. high replacement costs. While the market may be concerned over the possibility of an interest rate hike, we believe a stronger ringgit should support a stable interest rate environment, and this should be favorable for property buyers and investors. Based on our recent engagement with developers, the demand for commercial products for rental purposes is particularly strong. Recent launches of commercial shop lots at various locations by a few developers were mostly taken up, and this include UEM Sunrise at Villa Place in Iskandar, Malaysia, Signprop Reka shop lots in Elmina, the Cube Plus, which is by IIPROC, another IIPROC 77 units of a 4-story semi-detached shop office in Bandar Puteri Puchong, priced from 8 million onwards, fully sold. On the other hand, demand for resi properties for rental purpose will depend on location. Projects near to TOD, transit-oriented development, will typically see better sales, such as Atrium Residence by UA, which is around the Bukit Chaga area. SJCC is one which is by Signprop, is located next to Subang Jaya LRT and the KTM interchange. So overall, we are maintaining our overweight stance on the sector. The sector is currently trading at 50% discount to our NAV, which is around or almost +1 ST, having largely recovered from the recent correction triggered by the US-Iran conflict. Demand from both local and foreign buyers remains strong, and we maintain our and also value unlocking exercise news flow ahead of the completion of the RTS, as well as the unveiling of the GSSEZ investment blueprint and master plan in the coming months are share price drivers. Major land transactions by DC players should continue to provide our NAV re-rating for developers with sizable land bank in Istanbul, Malaysia. Our sector topics are Signprop and also EcoWorld. We like both companies for their solid track records, property sales that have never disappointed, strategic land bank and industrial product exposure. Both companies should also have stronger recurring income stream upon the completion of their core and shell DC facilities. For Signprop, the core and shell has already completed just recently, and hence the leasing income should kick in from late second quarter onwards. EcoWorld DC, core and shell DC will be completing in the second half next year. So that's all from me. Let me pass to the next speaker, Adam.
All right, good morning, everyone. So just a short one on Gamuda. So Gamuda announced it secured a 2.3 billion MRT job in Kaohsiung, Taiwan. So this is the 10th job for Gamuda in Taiwan and brings its outstanding order book to about 51 billion ringgit at another record high. So, margins for this project will be about 8% PBT margin and expected to be completed about 7 years from now. All in, year to date, FY26 wins amounts to about 21.2 billion ringgit, exceeding our 21 billion FY26 target initially. So we are bumping up our FY26 job replenishment assumption to 27, given that we view that there's going to be a lot more of the renewable energy push from Australia, so which should actually help to facilitate Gamuda's order book wins, which since Gamuda is also quite big in the renewable energy space in Australia. So all in, given that we tweak our job replenishment assumptions, FY26 forecast remains unchanged, but FY27 and 28 we bump it up by 3 and 5%, and hence we arrive at a new target price of 6.19 ringgit, previously 6.01 ringgit. So we maintain buy on the stock. We continue to like the stock given that it has various angles to look out for, be it your data center, renewable energy, and even water infrastructure. So that's about it, everyone. Thank you for dialing in into RGB Morning Kappa at 8. We'll see you tomorrow at the same time and same place. Have a great day ahead. Bye-bye.